Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall, and here with me today is Alistair Whitted, manager of the Comgest Growth Europe Fund. Hello, Alistair.
Good morning.
So, there's so much going on in Europe, it's difficult to know where to start, but with all that macro noise, one of your peers who also runs European equities said that he expects the European equity markets to go sideways this year because markets don't like uncertainty and there is so much uncertainty out there. What do you say to that?
I think certainly economically there is a huge amount of uncertainty, and I think that's partly why you're seeing the ECB engage in a massive quantitative easing program. And I think politically there's a huge amount of uncertainty for Spain and France. You're seeing the political debate being pulled by the far left and the far right, and essentially taking the debate away from, I think, much more important, from an investment perspective, economic questions. But I think even in that environment, there are a number of there are many pockets of growth, and and certainly for our fund, for example, we've found a number of industries and mega trends like the growth in diabetes care globally, which has been growing double-digit now for a number of years and will continue to. And this is driven by factors which are fairly irrelevant from the economy. So things like aging populations, emerging markets changing their eating habits, etc. So I think even in a no-growth environment, you can find pockets of growth, which means that even in a difficult economic environment for Europe, you can still find good investments.
Having said that, though, when the market gets a shock, be it economic or political, and it moves down, it drags good quality companies down with it. So how do you avoid being sort of dragged down by that slump, or is it about just accepting that 2015 is going to be a volatile year? I
think you have to accept it's volatile. And when you've seen that the market rise 20% year to date, you've got to think there is a certain amount of irrationality maybe in the market's movements. And as a fund manager, I think you have to take a longer-term view, and you have to accept that there will be periods, maybe a year, maybe 2 years, which are more difficult. But actually, in the past, for us, that's actually created some very interesting buying opportunities because you find these fantastic businesses which really shouldn't be marked down on the basis of economic or volatility, and you can buy them at very good prices. So I think for a long-term investor, it's not necessarily a problem.
And then let's talk a little bit more about thematics. You've mentioned diabetes. What else sort of sectors are you finding opportunities in?
Yeah, there are plenty. I mean, air traffic is a good example. We've been seeing globally air traffic growing at about 5% per year for the past 2 decades. This year, that's actually accelerating to 7%. And there are a number of companies which are nicely exposed to that. There's Amadeus, which is a booking platform, if you like, for airlines, and they've been experiencing high single-digit growth thanks to that. But there are other sectors, for example, the online market, which has been growing extremely strongly. Historically, for the last 5 years, has been growing about 15% per year. And Wirecard, one of our holdings, is a payment processor on the part of retailers, and they've been posting 20% growth for the last couple of years.
And both of those will benefit from the weak euro. Is that something you're intentionally doing?
Absolutely not. So our investment style is as much as possible to buy businesses which are disconnected from exogenous factors, be that the economy, be that political, and indeed, of course, currencies. But obviously, if you're selling something in dollars and the dollar's gone up against the euro, you will benefit from that. I'd be slightly more wary about buying businesses which have what we call transactional exposure, which is to say that they produce in euros and they sell in dollars. For example, the auto manufacturers, which incidentally have done very well this year, I think, on the back of that. Because even though they do well this year, tomorrow or next year, if the euro strengthens and the dollar weakens, their fundamental business model will be at risk. And as much as possible, we try and avoid that.
So you like to buy companies that do all of its dealings in the same currency.
Absolutely, yeah.
With that in mind, what do you feel about Greece? Because we don't know what Greece's currency will be in the future. Do you have any exposure to Greece at all?
Fortunately, we have no exposure to Greece whatsoever. And I think from what's the risk on the rest of Europe, I think that has been significantly de-risked over the last few years. So if we had had this discussion 5 years ago, the banks in Europe had significant exposure to Greece, and therefore a Greek default would have an impact on the whole banking system, and obviously we know the effects of that. Today, the banks have largely either written down or offloaded their debt exposure, and it's now basically in the hands of the ECB and the IMF, which I think are much more credit-worthy holders of that debt than the banks in Europe.
Alistair, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.